Thanks so much for tuning into Talking Point. It's good to be back after a brief hiatus, and it's great to have N. Jayakumar as my guest on Talking Point today. Jakes, thanks for taking the time out.
Thank you for having me over.
Now, the pleasure is ours. Jakes, lots of moving parts, as they always are. You would say, but just as we are getting closer to the election season, the noise around geopolitics, the noise around yields, and what could happen to rates, and all of that is growing louder and is kind of getting confluencing into a kind of single event of sorts. How are you seeing risk assets from your prism?
I think we have to see this in the context of flows in most markets have been negative. People have been moving out of, this is a period when you've seen that for most markets, equities haven't made money. Debt has actually lost money handsomely because yields have just kept going up. And gold has not performed. So there have been multiple asset categories that people have dabbled in and with, and they've not made money in most markets. To that extent, I think without necessarily jinxing this, but India stood out like a beacon on a dark night kind of thing. We've stood out much like the proverbial oasis in a desert, which is so many good things have been happening, which I think sometimes we tend to kind of take for granted or ignore. The most important thing is that we've always had this thing about a demographic dividend, large percentage of population that's consuming. That percentage of the population, 50% in the working 20 to 40 age group, etc., is actually now investing. So other than just consumption, we are now seeing the positive sides of their being in the market as investors, regular investors, either through AIFs, mutual funds, SIPs, etc. And if there has been one bulwark of this market, it's been the Indian retail investor. In the past, we've panned the unknown Indian investor, as it were, as the guy who comes in at the end and gets, killed for sort of making tops, etc. But far from that, this is the investor who's been there, buying in on most dips, doing SIPs, and actually standing in the face of very strong FII outflows as a result of international, interest rate scenario. And if you look at it and just see the way the markets have moved, if there is one set of investors who've made money at the expense, and it's, you can't necessarily name a few HNIs, but they're, in a sense, epitomizing the larger investor base. And there are ever so many HNIs that have, you can talk about family offices that have made money. And interestingly, mutual fund managers who are sort of star fund managers who've left and started their own funds have also made it really big. In fact, they are bigger market movers represented by retail HNI family flows than ever before. And I think very few interviews actually give pride of place to the leaders. And the leaders in this bull market have actually been individual investors. I think it's a big theme. We shouldn't run away from it. And as the Indian savings, which were moving to the equity markets, which let's say 5-7 years ago were at 2.5-3%, may have moved up 4.5-5% now. And as that tectonic shift takes place, given the kind of GDP growth, given the kind of quantum of savings, and therefore the money that has moved to the markets, I believe the retail investors, HNIs, family offices, they are the real leaders of this bull market. And I think what they do, what they are seen to be doing is probably far more critical than following necessarily FIIs who are mirroring what's happening in the rest of the world. And to that extent, if the rest of the world, most asset categories have been returning negatively, I think you will find India is what it is because of the categories I talked about. And I think any mention in the footnotes of history, this will be actually dedicated to be what's different this time is this particular movement of money from large unnamed hordes of Indian investors, first time employees, first time people who've been even people who've started companies, sold them out, they come into cash, they become investors in the market. I think it's a very interesting big shift and something we can't run away from.
Yeah, and maybe it's very small, but the sips done by the person who drives my car or the person who does makeup to me in my studios. I mean, all of that, Jake's so well put. Thank you for putting that into perspective. Just one question, is that also what is determining how, despite the fact that the Nifty as a headline may have been sluggish, you are seeing tremendous activity at the broader end of the spectrum.
Well, the fact that small and mid caps have been as popular as they are is also sort of symbolic or represented by the kind of money that I'm talking about.
Yes.
Big institution goes into large caps. So if you see really over a 2, 3, 4 year period, especially over the last 2 years, when let's say the Nifty's moved almost 25, 30%, maybe even more, you're talking about HDFC, Kotak Bank and stuff like that being actually the biggest underperformers in the market.
True.
Represented by over ownership by foreign owner for FPIs, etc. So over ownership plus the kind of owners who are actually being net sellers in the market represents underperformance. Small and mid caps have been massively outperforming, and the unloved, underowned, unfancied sectors in the market have performed, representing again the fact that where there's over ownership, where FI ownership is there, they have not performed, and sectors that are performing are those where whether new investors or those that have been unfancied and unloved. So I think there's a clear movement, and if there's ever a correlation you wanted between money movement and performance of stocks, the last 2.5 years pretty much represents that in form and shape.
Got it. Jakes, just one technical question before I move to what could happen per se as well. Is this a bunch of notes in the last 3-4 months talks about the exits of promoters, of private equity investors, and how that should be a warning sign. Now, my question to you is that a warning sign to you, or is this a new age phenomenon wherein the depth of the market has increased so much that exits are happening, and yet it is happening without too much of damage, and that did not necessarily be a precursor to downsides?
Well, add to it the fact that the first few exits that happened a few years ago in large measure were at 10 and 15% discounts to market. These days, the discounts, as when these WhatsApps come for next day offers, etc., are 2% and 1%. So that answers your depth question. So traditionally, for the last 25, 30 years, 35 years, anytime you said promoters selling or insiders are selling or big private equity guys are selling, would have represented traditional logic, traditional wisdom told you that that's negative.
Right.
Whereas the world today is, if it's a stock that's good enough, that a book can be created, how does it matter who sells? The fact that there is a new buyer represents a greater upside as opposed to saying some insider. Please understand, insiders are now restricted in terms of sales to certain parts of the year. So, for instance, at the end of the quarter, from the first day of the new quarter to the time the results are declared, they can't sell. So, if typically companies take a month to declare results, then you got 1 into 4 months of the year where insiders can't sell. So, insiders can only sell, and many of these represented by first stage, new generation and first generation entrepreneurs are folks who've actually created capital and therefore need to sell to generate capital. Otherwise, it's all book profits, right? People have needs for a house, people have needs for a car, people have needs for a whole bunch of things. And therefore, promoter sale is not being seen necessarily as something so damning or dramatic. And that also represents the modified or the evolved thinking of investors, where those who enter, private equity investors, also need to exit and get an exit. If the markets are illiquid, maybe the discounts are bigger. If the markets are not that illiquid and therefore are representing good activity, you can in fact get away even at par or at a premium sometimes. The whole concept here is that none of this, which is traditionally true, is necessarily true, and is definitely not being seen as something so damning that we should react the way we would have done so in the past.
Okay, thanks for that view. One final macro view, and that is this overarching belief of higher for longer. Even if the rates don't inch up dramatically from where we are right now, the recent commentary of last night seems to suggest that. If it turns out to be true, who knows? But even if rates don't go up from here, if they stay higher for longer, Jakes, is that a net negative, and should we reset multiples for lower and therefore expect lower returns from equity markets, or not necessarily so? How do you think about this?
So I personally believe that this higher for longer is kind of broadly discounted. In fact, the bond markets have discounted this long before it was articulated and orchestrated in words which the Federal Reserve is attributed to. People have seen this happening bond yields have gone up significantly beyond, have done as they say, that they've done the work of the Fed long before the Fed could do it. And therefore, I feel to an extent it's discounted. Yes, if this continues actually for, let's say, the next 3 years like this, you will have a decided marking down. So, for instance, cash-rich companies may continue to trade at our current level. So, if you take the 3 or 4 big FANG stocks, for instance, or whatever the new acronym now is, they will probably trade at these levels without too much appreciation. But because the cash in the books are so strong that there's a natural downside protection to how much they can fall, which means that if they don't perform in the next 3-4 years but don't fall too much, P's have already got derate. So the derating is happening purely in terms of price cap, not price-wise necessarily, but time-wise correction. If, on the other hand, interest rates actually start declining, you will find a greater discounting and therefore the multiples will go up. This is a natural kind of thing. I think the markets have factored this in, which is why you go back to when interest rates were at 2% in the US to now almost at 5%. The Dow has been well protected in the 32, 33,000 range. It hasn't really fallen too much, despite the markets are. Whereas if you started the picture by saying we're at half to 1%, interest rates will go to 5%, where will the Dow go to? I'm fairly sure most people have put in numbers of 18 to 20,000 in terms of traditional logic. But with the passage of time, with 2-3 years having gone, the market has discounted, multiples have come down, but the price-wise erosion has not been as strong as time-wise correction does take.
Got it. So, Jakes, thanks for that macro view, a bit of the technical view as well. I'm trying to pencil in that with the presumption that you are looking at the glass half full and not the glass half empty. The interesting thing that I thought was the choice of themes or pockets that come about in a discussion. Normally it's banks, IT, the 55-60% of the weightage. And here I see you, based on our last conversation and a few other conversations that you've had elsewhere, that you're looking at pockets which are not necessarily in that bucket. You're looking at pharmaceuticals, you're looking at metals, which you spoke about extensively the last time that we had a conversation. You're looking at media. Tell us, how are you thinking about choosing the horses that you are wanting to bet on?
So one thing I can tell you is that with the passage of time, in general, there's enough and more information in the markets. So people may talk. The question is, how are they positioned? So people may say markets are expensive, but in most markets, there'll always be bargains. So the way I'm seeing right now is try and see wherever there's consensus and move away from that. So if there is valuation comfort, if there is cash flow comfort, and if leverage is reasonably low, especially in these interest rate, these interest rate regimes, the way I see this is that if you take metals, I'm talking about integrated players with low leverage, which means that the fact that there is a higher incidence of leverage on many balance sheets indicates that they are far more keen on output pricing. Whereas well-integrated players with low leverage, they don't mind if the output prices are low, but as long as the cycle, which means that everything from raw material to end product is kind of well boxed in. And I think the important thing, for instance, is as converters, if you've taken care of, let's say, coal and iron ore, and you've got a reasonably well-oiled machinery in terms of the output, reasonably low on cost, you can still make money. And the strange thing is that when steel prices are at 85 to 90,000, the sustainable margins then may have been lower in retrospect than what people make today with steel price at 60,000 or 58,000, because the input prices have collapsed that much more. There are no takers in most parts of the world, and therefore the margins here are actually a lot better. So we need to focus on margins, which is one step more of a thinking than just the end product prices that people could have monitored. So people bought steel in inflated times when end product prices are at 85, 90,000. But because the government came down heavily, all kinds of these things, and the delta collapsed, people didn't make money, and you're likely to make money right now. When some balance sheets have actually improved by using the bull market to actually deleverage rather than add capacities.
Right.
A few players have added capacities, but I think 1 or 2 players have indicated that they'd rather grow capacities organically over a period of time than put in huge capex by borrowing against the profits that you make. So how you use a bull market is important. In commodity kind of cycles, you need to deleverage in bull markets and organically grow, so that in every new cycle, you have a higher capacity, more well integrated, and you got a lower cost of production. That's the broad framework for making money in the commodity space. As far as pharmaceuticals concerned, this is a sector that's virtually dropped out of bed over several years. Only for the last 2 years, there's a bit of here and there. The Indian pharma business has been good. The PEs of Indian pharma companies have been reasonably attractive. In fact, good, 20 plus multiples, sometimes even 30 plus on price earning basis, EV EBITDA multiples of 20 plus, etc. Where the industry took a hit was a lot of generics players saw price erosions, which since the last 2 quarters have actually abated. But the interesting thing is that with interest rates moving the way they have, a number of generics companies in the US have collapsed and gone into bankruptcy. So that's number one. Number two, with prices of everything going up, both insurance companies and individuals have been looking at the cheaper substitutes for generics as opposed to the patented products. So the insurance companies have been pushing people to, more and more look at generics. And a couple of interviews given by the US FDA commissioner recently indicated that the generics could become, value-wise, a staggering percentage of the overall US markets. And therefore, the entire orientation towards more audits, more frequent audits, and faster turnarounds indicates that the supply source from India, and they were very conscious of the fact that the supply source from China has been overstated, dependence has been overstated, and they'd like to move to India with a far greater turnaround time in terms of audits, indicates to me the generics for the next, I would say, 12 to 16 quarters would have a fantastic run. May not be price increases, but more importantly, stable prices. That's number one. And number two, for the first time in the commentary in the last few quarters, we've seen drug shortages in various parts of the US. And multiple drugs. There's a recent report by one of the bulge bracket brokerages which talks about 302 or 306 drugs in short supply. And I am, for instance, aware of the fact that the US FDA has actually called up different companies and talked about shortages, which if some of the Indian companies can supply on an urgent basis. Okay. This has never happened before, by the way.
Yeah.
So from that point of view, I think pharma could come back. Pharma is under-owned by them.
Yes.
The promoter holding most pharma companies is reasonably high. So the price impact of incremental buying could be a lot higher. Number two, it's a very, very small percentage of most portfolios. Most people have viewed it as a trading call rather than as an investment call. Cash flows are decent. Leverage is very limited in most cases. And some of the pharma companies, one or two of them, are getting into the PLI space, which means actually start manufacturing critical inputs and intermediates instead of depending on China, with concessions coming from the government, which essentially not only strengthens and secures their input pipeline and their end-to-end, if you will, but also makes us as a country more dependent on ourselves rather than outside world. Yeah. So the PLI-based generics, these are the spaces to watch it.
Wow. And therefore, just a quick follow-up. So therefore, in pharma, because healthcare is such a wide bucket, I've heard a lot of people talk about how they are avoiding the US generic, the Sun Pharma, Ciplas, etc. of the world, but focusing on the domestic healthcare or hospitals, etc. You are saying you actually like the exporters and the generic makers.
Absolutely, I do.
Okay.
And also with everything happening, the rupee is quietly moved into the 83s. There is a natural 1 to 2%, if not more, that they keep picking up every year. My thing is that for the next couple of years, US generics could be the space to be in. As I said, US generics plus PLI. And of course, the domestic market is growing, but the last 2 months have been actually pretty slow.
Yeah, which is true. The yesterday's notes as well suggest that the domestic ones have been quiet, but this is very interesting data. Thanks, Jakes. Thanks for bringing it out. Really appreciate. I understand you're getting late, but before I let you go, I cannot avoid talking about media. Least because I'm a media house myself, but you like that pocket, and that pocket has largely been a sluggish, if not a wealth destroyer, then certainly not a wealth creator for the last so many years. What has changed at the margin?
So what I think has changed is that habits have not changed. People still have their viewing habits. People have their media habits. At the margin, people have moved to apps and phones rather than television, perhaps.
Yes.
The important thing also is that they may move to OTT as much as they move to regular channels. But one thing that hasn't changed is consolidation on most of this. Lot of marginal players have fallen by the wayside. Consolidation is near complete. There are just 2 or 3 players pan-India right now, and 1 or 2 of them are listed, and they're making serious amounts of money. The 1 or 2 which are going through mergers, etc., have had their challenges. I mean, I'm talking about Sony, have had their challenges. But if you see the others, they're sitting on large amounts of cash. They're sitting on massively consolidated market shares in different geographies. And some of them have moved into a non-cash burn model for the OTT and doing pretty well, especially at the regional level, South especially. I mean, I'm not wanting to talk stocks, but you can sort of guess. So I think if you go back and see them and you strip away the other assets that they own, like a cricket team, for instance, every media company now has a cricket team. So if you strip away the value of the cricket team, strip away the cash, the core business is hardly getting discounted 3-4 times. This is a seriously under invested and ignored space, and media could make a lot of money like it does in the rest of the world. So I think the next 5 years could be very interesting, because this space, which has been largely ignored and which has been adopting and adapting to technology, adopting technology and adopting technology and adapting to technology, is actually, to my mind, should be compared with the kind of valuation that some of the big boys like, the international majors get, the Disneys and the, Netflixes kind of thing. So these valuations are at a serious discount, but with eyeballs and market shares the way they are today and making money, my own assessment is that their multiples will get re-rated, no question about it.
Such a pleasure talking to you, Jake. So much more for these nuggets as well as the macro view that you laid out so beautifully for our viewers. Thank you for taking the time out, and looking forward to talking to you soon again.
Thank you very much, and all the best for your for the TV launch.
Thank you so much. Happening in about a month's time. Really appreciate. Need all your support.
This was the unsolicited